Hello and welcome to St. Andrew's Economy. We are in Washington, the home of the Federal Reserve, also known as the Fed. It's the Federal Reserve of the biggest economy in the world, the United States. My name is Vitaly Shevchuk, and today we're going to be talking about the central banks and their monetary policies and how they impact not just the U.S. economy, but our lives. Let me introduce you to our Ryerson graduate, the winner of Nobel Prize in Economics, and the future AP Macroeconomics teacher, Kristen Jumacchio. Welcome.
Hi, Vitaly.
Hello.
So today I'm going to be talking about the monetary policy. So in macroeconomics, the monetary policy is laid down by the central bank with objectives to preserve the value of money, slow down economy, and keep inflation low. An ideal inflation target range would be around 2% for the US and overall economy. So this involves both the expansionary monetary policy and contractionary monetary policy, which determines the size and growth of our money supply. So the money supply is a financial wealth held by average citizen households, which includes coins, currency, demand, account deposits, saving deposits, term deposits, money market fundings, savings, anything like that could be known as M1 and M2. Also at the same time, the banks are limited in their ability to expand loans by the need to retain certain reserves. The central bank can manipulate our money supply indirectly by determining both interest rates and the ratio of banking reserves. One other method is also called open market operations. So this is the selling and buying of government securities between the central banks and the commercial banks. Also, one other method will be implementing and adjusting the discount rates to expand or decrease our money supply, by at the same time maintaining a relatively low and stable inflation rate. The discount rate is basically the interest rate charged by the central banks on loans. In my opinion, this will not be the ideal policy to implement because it has many disadvantages. First, the discount rate is not conducted by the federal bank. The commercial banks can decide their own. And also, the discount rate policy lasts for an extended period of time. It could lead to an inflation because more and more people lending could cause price to fluctuate since they are spending more. So let me pass it on to Vitaly over here.
In 2008, the world encountered its worst economic disaster ever since the Great Depression. Housing prices began to drop and the economy slowed down a lot. The Federal Reserve began cutting its discount rate from 5.25% in June 2007 all the way to 0 by the end of 2008. With the economy still weak, it embarked on purchases of government securities from January 2009 until August 2014 for a total of $3.7 trillion. So expanding the economy by $3.7 trillion and improving the investment. Okay, so this concludes our interview with Mr. Kristen Jumacchio. Thank you, Kristen. And there's a chewy bar for you. I know you haven't eaten food in a long time. And I'll see you later. So now I bring you the live broadcast from Hunan, China. Hello, Dennis Kang. Can you hear me? I think you have some news for us.
Hello, Vitaly. I'm broadcasting live from Taldor, Hunan, and today I'm here to talk to special rice farmers. Doing a live broadcast from Mr. Fan, a local rice farmer, on his experiences with recent economic changes. Hello, I'm from India. It's time for us to visit this local rice farmer in his natural habitat. Mr. Fan, I'm Dennis Kang from St. Andrews College, and I'd like to ask you a few questions.
On what?
About the recent changes in China's economy.
Let me get dressed.
You do you.
Let me get dressed.
Hello, Mr. Fan, I'm Dennis Kang, and I'd like to bring you to Canada.
What is Canada?
On my stick. Not that stick. Ready?
한잔 오면
Oh, wrong rice farmer. Oh. There he is. Hey,
Yeah.
Mr. Fan. Please tell me, can you please expand on China's current contractionary situation?
Contractionary situation. In the past 10 years, the rice price has gone up so significantly. Black rice, white rice, brown rice, yellow rice,
I'll just be
all gone up! What the is this? Nobody buys rice anymore because of inflation.
So, what steps is China taking in this fuming hot economy to kind of contract it?
The only way to prevent this is by doing contractionary monetary policy to decrease the money supply in the money market. In the end, the price will go down for all the goods, not only rice.
Well, that's all the time we had here with Mr. Fan. Thank you for coming all the way from Henan, and I will see you later.
I love America!
Hello again. So we're back in Washington with my Canadian colleague Dennis Kang. Dennis, could you please give us a little overview of what you've learned in your days in China?
So basically, to start off, contractionary policy in China was a very real application, and it's used to reduce the inflation, as we could see with Mr. Fan and the rice market. So since China has had an inflation of 6% in 2000 as compared with the average of around 5%, his central bank should implement a contractionary monetary policy to lower the inflation rate. Otherwise, their economy will heat up and hit a severe recession, just as we could see in the rice market, with prices exceeding to new levels, and how Mr. Fan could not sell and had too much of a supply. When the government raises the federal funds rate, it decreases the money supply. That's because the banks will charge higher interest rates on their loans to compensate for the higher interest rates. So then businesses will borrow less, and they don't expand as much, such as the rice farmers won't expand as much, and they'll hire fewer workers, decreasing the demand. They are also less likely to then raise the prices, putting an end to the inflation. However, such a change will increase the employment rate and reduce the growth rate. But again, this is inevitable to sustainable growth.
Thanks for tuning into this episode of Macroeconomics. Today you had a chance to learn about monetary policy, and specifically the two types of monetary policy. You had a chance to learn about expansionary policy that took place in America, and you had a chance to learn about the contractionary policy that took place in China due to inflation in the market. Thank you for being with us, and see you later.